Welcome to Let's Talk About Method Choices. So today I want to chat about different methods that we use to come up with risk rates and things. It's come up in conversation a few times with some other appraisers I've chatted with. And I put together a brief PowerPoint presentation just to help me keep track of my thoughts and provide some examples. So here we go. So different valuation methods. In performing a business appraisal, we have our toolbox, quote unquote toolbox, full of various techniques and analyses that we could perform, not every single one of which are applicable or even appropriate to use for every single business we might be asked to appraise. For example, oftentimes we're going to do, value equals income divided by risk. We're going to take an income stream, capitalize it, and there's our value. However, because math exists and we can turn things around, you can also look at it as income times risk to also get a value. There's a multiple. We need to pay attention to the underlying logic for each method we look at. And sometimes we have to look at an appraisal problem in a slightly different light than we're used to in order to come up with a credible value. So there's a couple of examples I want to get into. So divisors versus multiples. I have here two examples of two different methods that I pulled from a report I wrote a while ago. So one method, capitalization of earnings, is using a divisor. Most of us will know that as a cap rate or capitalization rate, and we'll come up with an indication of value. The other method, priced or revenue multiple method, is using a multiple. So with the first one, we have weighted normalized net cash flow, rounded. I'll bring my mouse around over here. Divide by cap rate, and we come up with operating value of 1.6 million, more or less. Some folks will wonder, what's this 10% down here? Well, in my mind, since the cap rate using the build-up method comes from an analysis of publicly traded companies which are liquid or marketable, I need to hit this with a small d-log in order to come up with an indication of value for privately held business. That's what that's for. So that comes up with 1.44. Now the price revenues market multiple method, I'm just using revenues here, historical revenues times it by 1 for the weight. That's going to be our expected revenue line for this particular method. Multiple is 0.35, arrived at based on an analysis of privately held companies that have been sold from the deal stats database. Then we add cash because I'm appraising equity, and then if they had any liabilities, you'd be subtracting those. So there's the sum of everything. So revenues times multiple plus cash gets us this number. So 1.5. So they're pretty close, right? That's kind of how valuation seems to work most of the time. But in an ideal world, each method would return the same answer, right? But realize we are imperfect people, and we like figures or numbers that end in 5s and 0s. So if I come back up here and look at this 0.35, if I'd used a 0.33 multiple instead, I would have come up down here with a 1.440 indication of value. You can check my math if you'd like. I'm pretty certain I did that right. But anyway, what I really want to get into the fact is that each method that we use derives its indication of value from a different perspective, or can derive its various indication of value from a different perspective. I'm not going to say will, because it is possible to take a market multiple, calculate its inverse, use it as a cap rate, and come up with the same answer that way. But if you're using the same underlying data to derive your risk rate for a capitalization of earnings method and a market multiple method, you're going to get one perspective. Two methods using the same data to come up with the same answer, basically. So you got to be careful with what you're doing there. If you do have different perspectives, different valuation methods coming together with different sources of underlying data in your analysis, ideally, those help support each other and can give the appraiser more confidence in their overall conclusion. Of course, that said, what really happens in the real world, when an appraiser comes up with their valuation, they do X number of methods and they each come up with wildly different indications of value. Well, I've seen two different options. I've seen one appraiser where they just simply shrug their shoulders and say, that's interesting. Let's average them all together and there's my number. I don't believe that's the best way of doing it or dealing with it. Personally, I like to say, okay, if I have two different indications of value coming up wildly different answers, I got to look back at my own assumptions. Did I miss something? I mean, there are specific factors that affect each value conclusion. Um, is there an adjustment that I missed? Is the expectation of risk different from one method versus another? I'm going to try to figure out if I made a mistake somewhere or if the underlying data was flawed in some way. For example, I do remember a project where I forgot to adjust out real property, and my market approach was coming up with weird numbers. Didn't make any sense. I'm like, realized, let's go back at the balance sheet. This thing owns some land over here. Let's remove that and remove that from from my analysis, and end up working out much better. There's also an option, specific company risk premium. Do I need to tweak that, make that work? Am I using the median or the average market multiple? Do I need to adjust it up or down based on how the financial ratio comparative analysis worked out? Are the financial ratios showing me that the subject business is more risky than the average, so I should use a lower market multiple than the average? Questions like that I have to ask myself. But anyway, so there's options and things that we can play with. And speaking of options, I have to ask these questions. Well, first off, why would an appraiser need options? So not all businesses are the same. We don't always receive good quality data. And the definition of fair market value talks about this hypothetical investor. But hypothetical investors or not, they're not always going to be looking at each business as being identical in its form of risk to invest, right? Therefore, we might need to look at different forms of risk in order to do these appraisals. So I have a little chart here summarizing a bunch of options we have. So risk equals rate of return equals discount rate. That's important to keep in mind. We have the build-up method, the weighted average cost of capital, the CAPM. We have all of those available. The inverse of a market multiple. So we have deal stats. We look at the market multiple, come up with that. Calculate the inverse, 1 divided by the multiple, gives us a cap rate, not a discount rate. Cap rate plus long-term growth rate is the discount rate. There's a factor rating method, which also gives us a multiple, and something called Schilt's tables. So I appraise very small businesses. Those first 4 methods get an awful lot of attention in our industry, but the last 2 can get used. They're options. They exist. So I want to spend some time talking about those, because when I'm appraising a business that does not have great financial records, sometimes I need to look at these other options. So one of the questions I see when I start talking about these is, do I consider the factor rating method or Schilt's tables to be great methods? And the answer is no. But they are better than just saying, I think this is the case based on no analysis whatsoever, which is the only other option. But while I'm talking about options and things, this is my favorite textbook. Gary Trugman just explains valuation theory and techniques in English. If you don't have his book in your library, you should get it. 6th edition is the most recent one out. But from that particular textbook, I want to point out this section here. As I mentioned a while ago, some of those options that we use for calculating value are not all applicable to the same income stream. And here it is from Gary Trugman. It's talking about some possibilities for what's going to be discounted or capitalized are these options. Net cash flow is one of them. EBIT, EBITDA, either pre or after tax income. Those are also options we could use. And he says down here, highlighted, the determination of which benefit stream will be discounted or capitalized will depend on various factors, including the availability and reliability of data. So if I'm appraising a business and I don't have financial statements prepared on an accrual accounting basis, cash, I'm going to be missing a lot of data that would allow me to calculate historical net cash flow, changes in working capital, things like that. So do I need to look at different methods to appraise those types of businesses? Maybe. So let's talk about the factor rating method. This is actually from Gary Trugman's book. Pause the video here if you want to read this section. You can. I'm going to move ahead and say the factor rating method is used to come up against seller's discretionary cash flow, right? So when you do this method, it's really only useful for small businesses, itty-bitty ones that don't have great financial data. You can calculate SDE, and that's about it. So basically, we rate a series of factors. Each factor is weighted, and then added up to come up with a multiple that again is designed to be used with SDE. So here's an example. I broke up into two pieces so it'll fit on the slide. I have this whole thing set up in an Excel file. If you were interested, let me know and I'll share it with you. So the weights 10, 9, 8, 7, 6, 5, 4. This was the way it came up when I first found this in the PPC's guide back in 1999 when I downloaded this thing originally. Those were the weights that were assigned there. So this math is multiplying my selected multiplier times the weight to come up with the weighted value that will be added up at the end. So each of these there's 10 factors here, and they're ranged from between 0.1 to 1, 1.1 to 2, 2.1 to 3, based on these little descriptions. So in this particular case, the business time was appraising. I chose 1.0 for the stability of historical earnings. So it fit better in this category than any others. 1.5 is right in the middle between the 1.1 and 2. It's a service type business, and you got to have some equipment. Now, those are kind of the thought process that I go through, and I'll write them out in the report narrative when I use this. But let me show you the second half. Here's other three categories. Multiple comes up to be 0.9. So if I have the selected multiple, I calculate it to be a capitalization rate. So the multiple, 1 divided by the multiple, gives me a percentage, 111.1%. I add the long-term growth rate that I'm using, 3%. And now I have a rounded discount rate of 114%. Some folks tend to freak out a little bit when they see a discount rate of that size. Remember, this is being applied to a much larger income stream, SDE, not dividend-paying capacity, which is what a build-up method or the WAC should be applied to. So if you're going to use one of these funky risk rates, you also need to apply it to the appropriate income stream, which is also kind of funky. So pay attention to those types of things. So Schilt's tables is another fun one. There's a story behind these. So James Schilt and Shannon Pratt were in a bar, I don't even know where it was, but they're drinking and they're talking about valuation issues that appraisers run into, appraising these smaller businesses with, frankly, crappy financial data, financial records. So then they came up with these tables. So the first article came out in 1982. I have a copy of it if you want to see it. Let me know. But basically the idea is appraisers should be able to use the pre-tax net income that you can calculate or off of their tax return or whatever you get, Schedule C maybe, come up with a rate based on a description of the business. There's a rate range, a couple of ranges they have. I'll show you the table in just a little bit. And add it to the prevailing risk-free rate, and that gives you a discount rate. And here's that table. So most of the businesses that I'm appraising apply to this fifth category where I'm using this method. They're just very, very small. These larger ones might have, well, they tend to have balance sheets and things that I can use to calculate. And if not under accrual basis, if they're just cash basis accounting, I prefer probably to use the factor rating method instead. But this also exists, so we got to pay attention to options in case we need to use it. There it is. So risk rates are very important. The method you use to select the risk rate is very important. The income stream that one applies their selected risk rate to is also very important. So that's why I want to spend some time talking about some of these less familiar options, because occasionally the method that you're most familiar with may not be the most appropriate for use with any of the particular business that's being appraised. Anyway, if you have any other BV-related questions, you can reach me by email or telephone. There's my contact data. I look forward to talking with you. Oh, and if you have any other questions that you'd like to see me address in a video or a newsletter or something, post a comment in the YouTube comments below. That'd be great. Thank you.